Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our Conversations show, we introduced Damian Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. Now, everyone knows we've been talking about yields, rates, emerging markets, but who better to bring on than Damian to go through what he's seeing, what he's hearing. So we'll turn it over to him. He'll introduce himself, and then we'll get into the rates world.
Yeah, no, thanks, Mark. Mark and I, just for our audience here, we worked together at Bloomberg Intelligence for a period of time there, got to know each other really well. My background, 47 years old, spent the early part of my career at Goldman Sachs and Lehman Brothers on the fixed income side, managing risk, then spent a bit of time on the buy side, allocating risk to other fund managers. Then I was a director of macro trading and sales at Citigroup. And then 10 years on the buy side running emerging market credit and equity portfolios for large institutions before spending the last 5 years at Bloomberg building their emerging market fixed income research unit. So that's where I am now. And this is some time to be in the market for sure.
Oh, I know. So clearly you don't have a lot of experience with what we're talking about. So when we look at what's happening, we've had nothing but crazy shocks to talk about. We've had the FOMC conversation. We've had Lagarde speak with the ECB. We've had the RBI come out in India, start talking about their inflation targets and how they're going to hold them firm as. So, we can go around the world, but let's focus on, you just had a great TV hit where you were talking about Turkey and Brazil. So let's start with Brazil. Let's look at Latin America. Brazil's facing a new COVID round, expansions, pressure there, and inflation starting to run a little hot. What are you thinking based on the moves that we're seeing in Brazil at the moment?
Well, I think it has to do first and foremost with the fact that debt to GDP is running hot at 95%. Mm-hmm. And with Lula now being exonerated, any idea the market had for fiscal reform to take hold in 2021 is thrown out the door, right? You've got Jair Bolsonaro, a conservative populist who likes to spend money, but has kind of promised the markets that, he was going to take down fiscal debt to GDP, which ran hot last year at 12.5% to something in the low single digits this year. Good luck with that. Right. I think he's going to have to spend money to try and unseat, what is now the resurgence of Lula. And, Lula, is definitely going to enter the political fray heading into next year's elections. And so you now have two populists, both of whom have made their mettle spending their way to power. And I think that's a real risk. And I think, market expectations are for more to come. And so, I don't think Brazil is going to be able to remove that spending cap. There's a lot of kind of jurisdictional mishigas that goes hand in hand with them trying to get that done. But, I think the price action in the real following the surprise rate hike today, or yesterday, of 75 bips, which was 25 bips more than market's expectation, says everything you need to know. The market is now fading that move. Mm-hmm. The rail's it's struggling to hold on to those gains, Mark. Right. And, the promise of more pain to come is evident.
Yep. Now, just for those listening, there's always a difference between that monetary and fiscal side. So when you think about monetary policy, that's when you're looking at the central bank. What are they doing? And they're going to try to go ahead and adjust some of that inflation because they need that fiscal stimulus. And as Damian's talking about, when you're looking at spending, those caps become a problem. And then, when you look at what's happened there with their difficulty in the grains market, just because of droughts, floods in different locations, they're struggling to get dollars back into their country, and they're finally starting to get some of those beans, those specifically soybeans, into China. But there's that delay factor. How much are you concerned when you look at some of the accounts balance when we're looking at these delays on grains? How much could that put additional stress on the fiscal side if they're just not getting those tax receipts? Because you're looking at export tariffs, import tariffs that they're trying to manage. Where does that leave them on the fiscal side?
That's a great question, and without getting into the nitty gritty, it doesn't leave them in a good place. What's really impacting markets right now, I think, is a crisis of confidence. Bolsonaro removed the CEO for Petrobras, who had done more about this than I do, Mark. He had done an excellent job of divesting of non-core assets. Right. PBR as an equity holding had become sort of a a great performer in a lot of EM equity portfolios. I'm a fixed income guy, but suffice to say, there's a fundamental reason for that, a justification for that, as it were. But now, as you're right, with tax receipts going down due to everything you just said, guess where the government has to turn to generate revenue? They've got to tax Petrobras, and obviously the CEO probably didn't take very kindly to some of the things coming out of Brasilia. But nevertheless, Bolsonaro had his way. He's now been removed. And on the heels of that, I mean, the Ibovespa has basically gotten crushed, and Brazilian equities are getting killed. And now I think there was just a news article that came up this morning where Itaú, which is one of the largest Brazilian banks and probably its most revered investment bank, is saying that new issuance in the equity market in Brazil is going to basically come to a standstill here, just because there's no demand from offshore for anyone who wants to get invested in in local equities. And so I think that's the real fundamental issue. How can Brazil convince offshore investors to come back onshore, especially in light of what Bolsonaro is doing, kind of making it an unhealthy environment for corporates operating locally on the ground.
Mm-hmm. Now, when we think back to 2013, and we have the taper tantrum, as we all remember, and you had this huge move in the U.S. Yield curve, which then impacted the emerging market yield curve. And now we're seeing something similar, obviously, and people like to remind me, yes, I know rates aren't where they were, but rate of change is a thing, and it's becoming a bigger concern. And we're starting to see some similar outflows from emerging markets as some of that concern comes back. Now, when you look at Brazil, and then we'll move on from Brazil because there's a lot to talk about, but what does their borrowing case look like? And are they going to see their yields really start to ratchet up as we see the yield curve in the U.S. starting to steepen and putting pressure? Because typically the 10-year Treasury in the U.S. kind of drives where things are going abroad. But we had that correlation break down. And now over the last, call it 6 weeks, maybe 8 weeks, it's really snapped back. And we're starting to see emerging markets really track that rise in the 10-year, and if anything, overshoot it at this point. Now, how much do you think or do you think the taper tantrum is just going to kind of peter itself out, or is the market really going to force Powell to act, and then you'll see that response in the emerging world?
So, I mean, a lot of questions there. First, just, settling things up with Brazil. The Brazilian local yield curve is steepened quite considerably. Right. But we must remember that from a benchmark, from an investable standpoint, from the perspective of benchmark-oriented passive EM fixed income investors, Brazil is one of the lowest duration countries on an average basis in emerging markets, quite frankly. I think together with Turkey, those two countries, and there's a reason for that. They can't invest a lot of long dated debt because there's no demand for it offshore, right? I mean, people just aren't willing to hold, and carry in Brazil for extended periods of time. It wasn't always this way. It's just become this way in recent years. And that's the real problem. How do you push, investors further out along the curve and give them the confidence that, that they're not going to lose money, certainly on the FX, right? From an offshore perspective. You're talking about a currency now. I mean, the real is off 34% over the last 5 years. The Turkish lira is off 61% over the last 5 years, Mark. So, I don't care what the carry is, I mean, that's a very volatile market to be, kind of buy and hold and for a medium-term investor. In the front end of the curves, obviously there are opportunities. There's opportunities to receive on these spikes in yields. And I think, in time you're going to see, what I like to call as voyeurs or renters or offshore speculators kind of carrying in the front ends of these markets, but only when, and you've hit the nail on the head here, only when the Fed has found religion. Right. And, I'm 47 years old, I mean, it takes a long time for me to think back to the early 80s and the Paul Volcker years, but we just had a Philly Fed print of 51 this morning. We haven't seen that since 83. Right. So, I mean, there are signs pointing to the fact that this is going to be an inflationary environment. Right. And that is never, ever good for, first of all, for U.S. yields. And by default, as you rightly point out, that correlation, that long-term persistent correlation between the U.S. 10-year and the contribution to return from duration in local emerging market debt is as strong as you can find. So, I believe it's a negative environment for emerging market local currency investors. I think the reason for that is clear, until the Fed basically decides to put a bit of a cap on the long end of the curve, the market is going to pull on that thread until it snaps.
Now, and for those that, just for the terminology, so duration, we're talking about time along the curve, with the short end being things that expire at the front end. That could be 6 months, 1 year, 3 years. And then as you start going further up into the longer duration, because let's be honest, do you want exposure to Brazil for 30 years or the US economy for 30 years? So that's where you start to look at that duration or that time factor. And it's interesting when you start talking about the Philly Fed, because prices paid, which is what the corporations pay, is at the high that it hasn't been since March of 1980. Then when you look at prices received, which is what's being pushed down, we're starting to see that come up. That's reaching the high that we saw in 2018 and now 2004. So that's the inflationary cycle as you start to see it come down the system. But now, like you said, pivoting over into Turkey, because it's just a very interesting point to, given they are a part of NATO, there is that unknown about what is happening with their economy. Where they've tried to increase their spending on the military. They've now find themselves on the wrong side of the U.S. and EU when we start looking at the geopolitics. So when you're looking at that, how much of the geopolitical risk is being priced in versus some of the issues internally on the GDP side?
Well, the problem is the ability for the Turkish market to give you a fair clearing price and where you can really trade is really not there because of capital controls that have been put in place over the better part of the last 3 to 4 years. Mm-hmm. So when we look at, the cost the expected return from carrying in Turkey for, say, 6 months or a year or 2 years, we must remember that while it's really easy to get your money into lira and into Turkey, it's not as easy to get your money out. And right. So, what might be a 6-month expected return or yield to maturity on whatever paper you're buying in lira terms could actually be the yield on a year or two, 18 months out, because by the time you jump through the hoops and get your money out of there and repatriate it into dollars, it takes a little bit longer. Right. So you have to kind of remember these things from a trader, from a practitioner standpoint. But the real issue in Turkey, Mark, is the fact that, locals have moved their savings from lira-denominated deposits into dollar-denominated deposits and gold. And to get them to move back, to bring their money back onshore into lira is a hard sell, even for Governor Ogbal, even the fact that he is taking a much more traditional approach to fighting inflation by hiking rates, because we all remember early on in Erdogan's presidency, he was, an advocate of, lower rates will actually bring down inflation, which, right. Clearly, he's kind of taken a 180-degree turn on. So, Turkey's got its own problems. I do believe from a political standpoint, you're right, the sanction risk, the fact that, it bought the S-300, missile defense system from Russia, all that stuff, I forget the name of the pastor, there's been a lot of stuff in Turkey from a political standpoint that, investors have had to contend with. But in recent months, you're absolutely right. There have been, since Governor Ogbal came to office, the lira's up, I think, 14%. Ogbal's the central bank governor. And, he's doing everything he possibly can, but the timing is really, it's just poor because, with inflation running hot, and let's be very clear, the inflation pulse in emerging markets, specifically one with a current account deficit like Turkey, is far greater than we're feeling here in the U.S. And it's going to be far more significant. And so if, the CBRT, the Central Bank of Turkey, thinks that it's going to basically do it's going to overshoot in terms of hiking rates more than the market expects, and that's going to stop inflation in its tracks, I think it's going to be a hard sell for investors, quite frankly.
Absolutely. And when you talk about, being in dollars versus the lira, how much of that can really change, just given where people are sitting, their concerns in the lira? When you look at, obviously there's the stated inflation rate, and then there's the real inflation rate that the market is seeing when you start looking at black markets, shadow markets, and some of these things where there's always been talk that the Turkish inflation is much higher than what is actually posted, because people would rather transact in dollars instead of transacting in lira. And then there's obviously a premium that's paid on that. I mean, how much of that can actually be cracked down in the near term, or is that something that's just going to take time after developing over the last couple of years?
So, I mean, look, if we're talking about data quality out of Turkey, I'm going to have to kind of expand that into the whole of EM, and we're probably going to wind up talking about China more than we should about that, right? Because when you calculate GDP on a value-added basis as opposed to an expenditure basis, clearly what you're saying is the Chinese government can basically invest in infrastructure and juice up GDP as much as it wants, right? Mm-hmm. And that's what's been happening. And we can go into that. We can go into whether the data we're seeing out of China is actually going to be good for the global economy, and it's going to be good for emerging markets. We'll debate that later on in our conversation, I'm sure. But, as it relates to Turkey, I mean, look, it's going to be a real challenge for them because they're fighting, political risk, they're fighting sanction risk, they have a credibility issue, and quite frankly, they just don't have the ammunition that that they once did in order to kind of fight the specter of inflation, right? I mean, their reserves are down, unemployment is through the roof, inflation is through the roof, but as you see, right now, with them hiking rates, that's eating into net interest margins for Garanti and Akbank and all the big, for the entire financial sector. Mm-hmm. And it's just making it much more challenging for them to extend credit and, kind of get the economy going in the right direction, not to mention all the issues that go hand in hand with the AstraZeneca vaccine and everything else that's happening in Europe, right? So, and so Turkey's got its own set of issues. I think, they're doing the right things. I think it's just going to be really challenging for them to continue this path of hiking rates to try and get in front of the market when the market is clearly moving in that direction. Eventually they're going to take a pause, and then we'll really see what the market thinks of Turkey and the lira.
So you're moving in that direction, and one of the love-hate relationship that they have is with Russia. As you said, that they bought that S-300, S-400 system, trying to make amends after being on the opposite side of political battles in Libya. Then when you look at what happened in Armenia, and then obviously what's going on in Syria. So there's still something there, but now let's turn to Russia, where, right now, even on a down day, you still have Brent at 65, but yet Russia's still struggling to clear their borrowing deck. They still can't get people into their offerings. And even at these interest rates, where essentially the market is saying there is no interest rate in which you can pay me that I'm comfortable taking this risk. Now, is it a political issue? Is it a commodity issue? Where do you kind of put some of these risks? And is there anything that Putin and or the central bank can do to try to adjust some of that to attract more buyers?
So I think taking a step back, you hit on a really interesting point, which is unlike past cycles, the correlation, the beta, as it were, for some of the, call it, commodity oriented currencies like the ruble relative to oil, or like the Chilean peso relative to copper, or the rand relative to gold, those relationships are not nearly as strong as they once were. Right. And I think a lot of that has to do with the environment we live in, the fact that the king dollar and U.S. yields and the emphasis that the market is playing on this U.S. exceptionalism theme and how that's kind of feeding through into the markets. Mm-hmm. So one would have thought that the ruble would have had, would have gained, and appreciated significantly more with oil prices going to where they were, and with the fundamental situation in Russia being, quite frankly, as good as you're going to find in most emerging markets, right? So, all of that going forward, yet the ruble's underperformed and people aren't buying local, Russian denominated debt, even with the yields attached to it. Now, I think you have to look no further than some of the headlines we've seen just today, right? I mean, it's been a hell of a day in the market. So if you just kind of, I'll do it for you, the fact that Biden called Putin a killer, and that, Putin responded by wishing him well. This tells us everything we need to know as we have delegates going to Anchorage to speak with the Chinese. It's really interesting to see how this Biden administration is responding to Russia in its first 100 days of the presidency. It's really taking a hard line, and that creates quite a bit of uncertainty, I think, around it, and from the perspective of offshore investors who might be looking to take advantage of those yields and that carry there. I think one other thing we have to be mindful of is we have, Governor Elvira Nabiullina basically saying the party's over. She's going to start raising rates again. She sees the specter of inflation coming through. We had the Norges Bank on Bloomberg just this morning saying much the same thing. Mm-hmm. So, people are expecting, economies to overheat and inflation to kind of come along with it. And I think that, if anything, more from my perspective, because sanction risk aside, political risk aside in Russia, these are nothing new. For me, what's new is the fact that the Fed is not putting a cap on the long end of the U.S. yield curve, and it's going to let the U.S. economy run hot. And that is a real kind of game changer, I think, from the perspective of investors looking to local currency debt, specifically in Russia.
Right. Now, when you're looking at Russia, I mean, when they've tried to do things to price in euro, to price outside of the dollar, to try to avoid some of those sanctions, whether it be against SWIFT, U.S. dollar denomination, banks. I mean, is there any kind of pressure that you see coming out of Europe? Like, is there, like, we've had that separation between U.S. and Europe, where Europe has started to try to do its own thing when President Trump was in office. Are they going to try to reset that relationship and maybe turn away a bit more from Russia? Or do you kind of see this as they're going to do what's right for them and they want to use the euro as much as possible away from the dollar?
It's a good question, but if you just listen to the rhetoric out of Washington, and quite frankly, you've heard much the same out of Europe, out of Brussels, and other kind of venues. I mean, what seems to be kind of resonating is that the U.S. doesn't want to pursue sanctions unilaterally any longer. Right. This isn't a Trump administration. And so I think that stems from conversations, obviously, they're having with the EU and the UK regarding how to approach Russia, and whether or not, because sanctions don't work if they're not kind of a unified effort, or they don't work as well. And so I think before the EU tends to kind of move in that direction, it would have to do so with the blessing of the U.S. Now, that's not to say that I don't think they have it. I think the reason the U.S. is taking a hard line, and quite frankly, much of what you're pointing out with you, is because they have discussed this in great length, and I think they feel quite comfortable taking a bit of a heavy hand here with Russia. We'll see how that works. Right. Russia is, I mean, we've said in the past that, a lot of the world leaders out there are playing checkers and Putin's playing chess. and I kind of have to agree with that. He's done an admirable job, given where the Russian economy is, of staying in power and securing his power base and making sure that the Russian economy is kind of, at least on the surface, appear to be moving in the right direction, even though we all know what's going on under the scenes.
Right. And when, last thing on Russia, and when you see, this is really the first time that we've started to hear that the sovereign fund may be tapped more aggressively this time to provide infrastructure and provide some backing. I mean, do you think that that's more of a signal to the market that, look, if you come in, we're willing to back you with sovereign money? Or is this kind of a show and you don't see this actually as a follow through on the back end of offering up sovereign wealth support?
I think Russia's very discerning in its partners and who it intends to help. I think, that news may very well be, it may very well be meaningful to investors, but I really do believe that, Russia wants to do business with friendlies. And, I mean, you mentioned, the Azerbaijan and Armenia and, everything that's going on in the Caucasus. And, you'd be amazed at what a friend Russia can be to many of those economies when it needs them, right? I mean, remittances from Russia to many of those economies are what's keeping them going and what has kept them going through the midst of the pandemic. So, you have to kind of put things in its proper perspective. And I think, just as it relates to, its relationship with the U.S., Russia's made it very clear that it's not really that important to it in this environment. Right. Its relationship with the EU is different. And so we'll see what happens with Nord Stream and with Germany and, how things proceed there and whether or not, they're willing to play nice. And, but again, I don't hold a lot of credence in it because, quite frankly, it seems like, the pivot toward the East, Russia's pivot toward the East, its pivot toward China is kind of going full bore right now. And it seems to me that as those two economies move closer, that this is all setting up for those two economies to move closer and closer to one another. Right.
Now, looking at that and shifting over, so when China attacked India, or if you want to say that there was a confrontation in Ladakh, Russia waited an hour before they backed India and then sped up the delivery of the S-400s, some of the additional equipment on the MiG side when you start looking at aircrafts. So is this Russia trying to play both sides to see how do I play China because I need them for my Urals, my ESPO, my crude, but at the same time, India has been a longstanding friend. We were together during the Pakistan. We were together when the U.S. was backing the Taliban. So now that we're getting to this point where they're not there yet on if making that choice between China and India. But when they backed India, Australia did the same thing a few hours later, and China has sanctions against Australian assets, but not Russia. So clearly they see the importance. I mean, where do you see Russia, and how are they trying to play or manage that relationship between their old ally of India and a new frenemy, if you will, of China?
I mean, this is a really great question, and we could probably debate it for hours, Mark. But for me, I'm not going to try and get in Putin's head, but historically, the Putin way has been to sow discourse and to tie up, its I don't want to say enemies, but it's to tie up the U.S. and others in areas of the world that are going to deviate their attention away from the matter at hand, right? We can point to a million examples of how it's done that, in the Middle East and so forth. I don't think this is anything different, quite frankly. I think, there's a benefit to China, to Russia keeping China engaged with India in sort of a confrontational way, just because it kind of takes their onus and takes the focus away from them. But, suffice to say, I think you make an excellent point in the fact that, some of the sanctions, in response to this, that China's kind of levied against Australia, it did no such thing against Russia, which shows the importance that Russia carries in the eyes of President Xi and in the Politburo and in China. And so, I don't see that changing anytime soon, because I think China, despite the fact that they're probably not pleased with it, realizes that, its best friend right now in its kind of, and what's going on with China and the U.S. is Russia. And so, it's a key relationship of it, and it's not going to do anything to kind of damage that, I think, at this stage.
Which is why we like to say that Putin is a real life Bond villain, just based on his intelligence and how he's positioned himself throughout all of this. But now pivoting over to India. So Modi has increased the fiscal deficit much more than what the market was expecting. We saw a pretty hard bounce in inflation by about 1% above where it was, still within the threshold of that 2% to 6% range, with the hope or target of 4%. But now that we see the fiscal balance, tax receipts were down again. We have petrol pricing at record highs, and now they're facing renewed lockdowns. What is the option that Modi has on this fiscal deficit? Is he going to have to maybe pull back on some of the stimulus? Will the bank have to raise rates to allow the fiscal side to work and cut back on the monetary? I mean, how are you kind of looking at this point?
It's funny. I'm looking at India much the same way I'm looking at, in Indonesia, for example. India's had to be active. The RBI's had to be very active in terms of quantitative easing, in terms of secondary bond market purchases, in terms of supporting its fiscal deficit by basically buying up the debt itself, right? So, this takes me to more of a fundamental issue. Quantitative easing works in places like the U.S. because the U.S. can print dollars. It's very, very difficult to do an emerging market when they don't have the ability to print their way out of such issues, right? So, so I think one of the big overhangs from all of what we've just witnessed over the past 12 months in places like, and we're seeing it now in India, in Indonesia, and South Africa, just because what they're forced to do now is revise back its budget plans for the full year, because it knows it's not going to be able to issue as much debt in the market because there's just not demand for it, especially now with U.S. yields going up. It makes it that much more challenging. So I do think, in this instance, it's not really a decision, Mark. He has no choice. I mean, I just don't think they're going to be able to, get the demand to issue the kind of debt that it had been expecting. Now, I say that this minute, given today is March 18th or March 19th, I forget. But, fast forward a few months down the road, and if we see, basically U.S. yields stall, and we see the U.S. economy not coming back online as quickly as we otherwise thought, and people are saying, wow, investment grade debt looks pretty attractive at these levels. U.S. treasuries are looking pretty good here, and we start to see things retest lower, which, by the way, I'm not saying that can't happen. That's a very real possibility in my mind. Then, we could then see, I think then we can see a little bit more spending, a little bit more leniency with the fiscal cap and what have you. But, I'd be hard pressed to not tell you that I think the market's going to interpret sort of spending constraints as a positive for the Indian rupee in the near term, which is kind of my position. I wouldn't be I wouldn't be receiving in India despite those lovely high yields that they have here. But I could see a short-term pop in the rupee, certainly amid, some more, a little bit of fiscal prudence here and there.
Right. Now, when you're looking at an India, you talked about them buying in the secondary market. I mean, do you know how active they've been or what they've really had to do to step in to kind of support some of the offerings that have been out there?
Well, I don't have exact numbers for you, but I mean, the market pretty much is aware that they've been very active in supporting some of the new, some of the recent auctions. And look, I mean, look no further than the fact that, we've had some kind of fund manager blowups in the Indian rupee denominated corporate credit where, the government had to step in and kind of bail people out as well. Remember, IGBs, Indian government bonds, are not benchmark eligible yet. And that's kind of a key point because, like from a classic, long only traditional, kind of bond investor perspective, it's unable. I mean, it's going off benchmark if they want to invest in IGBs, even with those high yields. So look, the verdict is out as to whether or not, they're going to be able to kind of reignite foreign demand in the near term. I do, however, think that if they start to bring down capital controls and, sort of make the, the markets a little bit happy on that regard, you're going to see IGBs added to a lot of major bond indexes. And that's going to kind of create this sort of virtual cycle such as we've seen in yuan denominated local debt, right? Like CGBs, which are basically, quite frankly, one of only two asset classes that I know of in emerging markets that are up on the year. And by the way, I mean, this takes me to a broader issue. I mean, Mark, this is a bear market for bonds. Okay. Right. If I tell you right now in the Bloomberg Barclays Global Aggregate Bond Index, the $67 trillion beast, if I told you that every single country, from an FX perspective, if I broke the entire universe up by currency denomination, all but one are down on the year, and the one that's up is China. So, what that tells me is that two things. Number one, obviously, people still care about carry and rate differentials, so it still has some meaning. But more importantly, they care about currency stability. And, we've seen a lot of currency volatility. Now we're seeing rate volatility come back into the market. And, that just has not historically been a really kind of good environment for investing in non-dollar denominated debt. But it's amazing. I mean, just how resilient, CGBs and policy bank bonds in China have been, all because of the fact that, I don't want to say manipulation, but because, the PBOC can smooth the dollar yuan cross rate, which is what they're doing.
Right. Those little adjustments. And before I ask you on that question, there's one more when we're looking at India. With them being a big focal point with what has been called the Quad, if you want to think about means of addressing China expansion, do you think that as we look to try to bring India further along, that the U.S. could help them along? Where, if you think about their importance to our supply chain, specifically on the healthcare side, then you start to see their importance against the China push, when we think about the Asian movements. I mean, and then we're looking at addressing the ASEAN and the RCEP trade deal. It seems like it would make sense to enable them a new place to place some of their bonds to speed along some of this recovery.
I mean, I 100% agree. I think that India is going to have a critical role in foreign policy from a U.S. perspective, not just over the next few years, but over the long term, just as a buffer to China. And so, that would, in theory, though, Mark, be the right move. Whether or not the current administration kind of wakes up to India's importance from a strategic standpoint, not just from an economic standpoint, but you're absolutely right, from a strategic defense standpoint, the role it plays, I think there's no denying the fact that the U.S. is going to go even out of its way to make sure that, India's got a place in major bond indices and major equity indices, that the economy, that their markets open up in such a way that's not only beneficial to them and keeps them strong to kind of buffer what's going on in the Far East, but also, you're right, from an ancillary impact and what that means for, jobs back home and for the U.S. economy as well. So look, I'm not about to project what the Biden administration has in store for India, but I got to believe that it's a very big supporter of Modi, and he's as yet done nothing wrong to really deter them.
Right. Now, when we shift over into everyone's topic that they were probably waiting for, China, when right at the end of January, we saw this huge spike in Shibor, and we know the PBOC has talked about taking some of that liquidity out, trying to manage because their debt levels, whether you want to say it's only internal versus external, their debt levels are massive. We're talking about on a provincial level, almost 90% of tax revenue goes to just interest expense, and on a national level, it's something closer to 50 to 60%. So there is a debt problem, and they're looking to address that. But they, like you just said, they opened up their market to the international side. They were able to unload and tap into some of this, and they're really just getting started. So does their movement into the international benchmarks and the global benchmarks help kind of stay some of these issues that we would have had if they didn't get into them, because they would have struggled to reissue, to renew, to expand, and this is some running room? Or are they running too hot and there's really not much they can do, and we're going to have to see a marked economic slowdown to really try to take some of that liquidity out of the market?
So a lot to kind of unpeel
there.
Mark.
Sorry about that. I got carried away. I apologize.
Lots to unpeel there. I think the first thing I'll say with regard to investors, foreign investors into China, is investors are lemmings. We like performance. We like returns. And when you show me a market, especially a fixed income market, which is supposed to be the ballast of your portfolio, that is rising when the rest of the markets are falling, forget about the level of the price increase or the total return increase. The fact that it can even serve as a diversifier for your sort of, for your core kind of, fixed income or whatever it is, the ballast to your way. I don't quite think, you just can't really underestimate how important that is in the psyche of investors. So this is all going to go by the wayside, but people are going to go back and they're going to look what performed well in this environment. And they're going to see, wow, China-denominated local debt is performing really well in this environment. And they're going to say, well, there's got to be a place for it in my portfolios going forward. Maybe it's not a 10% allocation, maybe it's a 2% allocation, but nevertheless, investors follow returns. They follow performance, and they tend to go around. They tend to go in a circuitous fashion in order to arrive in those destinations and try to extract those returns. If you follow me, so despite the fact that you've got governments and capital controls and things going up, and look, I want to be very clear. Gu Shuqing, the chairman of the CSRC, was, at the NPC just a few weeks ago. Some amazing comments that I had never heard. First of all, China pointing at bubbles in other economies, pointing to the U.S. and the European markets as being bubbles, to those bond markets. Unbelievable to hear that coming out of any China policy, quite from first of all. Secondly, the fact that it said that inflows into China are, quote unquote, controllable at the moment. That tells me as a foreign investor everything I need to know about the way the Chinese government thinks about my money that's coming into its government in order to invest in its local markets. They consider me to be, quite frankly, something they can control. A means to an end, as it were. It doesn't give me great comfort that when things go pear-shaped in China, that I'm going to basically say, okay, this has been fun. Thanks for the incremental income. I'm now going to take my money out, that they're going to be waiting to let me take my money out. And we know that in 2015 and other years, that's been the real issue with China. When the gates go up, things go horribly wrong in China, and you see, meltdowns unlike we've ever seen. So I'm not projecting that's going to happen again, but it's certainly a risk that resonates in my mind, especially in lieu of what's been going on here. But, China, look, to their credit, they've managed this as well as can be expected. They've got their economy kind of pointed in the right direction. Maybe the numbers, people may not believe them. And certainly you are seeing some pockets of weakness. Look at the oil market, look at Asian stockpiles, all the stuff that and love, and it kind of smells a little funny to me. But, through it all, for China to deliver stable returns on the fixed income side to offshore investors and returns on the equity side goes a long way in the eyes of investors, certainly myself. Right.
And when you think about, they ratified the RCEP trade deal 4 months ahead of schedule. They're trying to put that pressure to increase that, what Xi has called that dual circulation strategy, trying to generate, because those pockets of weakness is something that we've always talked about, is that difference between a supply recovery and a demand recovery. And they still are missing that demand recovery where they're not seeing the local purchasing, and they want to open up some of these markets because then to your point on some of those concerns, we've heard a lot about anti-monopoly. We've seen the pressure coming into a more party control in some of these, not only foreign, but also local entities, which is giving people a little bit of pause. They're like, well, what is party control? What is following a narrative that is being outlaid? But to your point, it's returns. And if the returns are working, is it going to kill me if it's 2%? No, but it'll be nice. But you're not going to want to get overweighted, because if everybody runs from the exit at the same time, all of a sudden you have these gates coming up. But
Mark, let me just say this. This is a very, very unusual environment. I gotta share this with you because I was just running the numbers. I took all of the full year fair value return estimates for all of the strategists that I work closely with at BI, in munis and mortgages and treasuries, Ira Jersey, myself, everything in fixed income, Noel Hebert, in credit. I have tried my best to work those numbers into my models and to come up with a total return estimate that's going to be positive for the full year in broad fixed income, call it the Bloomberg Barclays Ag. It's impossible. Right. Basically where we are today, based on everyone's full year estimates, the Ag will be down 1 year from now, right? Right. That is, quite frankly, as unprecedented as I've ever seen in terms of environment. So the question then becomes, Mark, well, where do you go? Right. In a bear market for bonds, where do you go? And that's why this environment is so different, because in other kind of environments, there was a different answer for this. But in this environment, get this one, you want to cut duration, right? Okay, so you want to go into the front end into short-term paper. You want to go down in quality. You want to go into high yield because, again, it's shorter duration. And because, as an economy sort of comes back online like the U.S., you would think those cyclical industries like energy and basics, which are kind of overweight and high yield, would kind of do more, and you have a little bit more spread cushion there. And you go into non-dollar assets, and that's what that's all that's left, right? Because and when I say non-dollar assets is because, quite frankly, you've got more FX premia there, and you stand to kind of make a little bit more money but now you kind of take a step back and you say, okay, I hear that's the playbook. The dollar, in a rising yield environment is actually doing the right thing. It's actually appreciating, right? So that makes any non-dollar investment go out the door. Yields have already come up so far, so fast that you're going to eventually start to see guys nibbling away at the long end, and certainly in IG credit. And, now you kind of take and you look at high yield and you look at, okay, fine, default risks come in, but, have we really seen the end of delinquencies? This economy is, economic slack in this economy, it's going to be very difficult to overcome that. And I don't believe that we have even scratched the surface of some of the pain that is out there in the corporate sector. So, it's, what the textbook would tell you to do in response to what we're seeing here in a rising yield environment is really actually a very risky proposition for your fixed income ballast of your portfolio. So, this is what investors are grappling with right now. So what are they doing? They're throwing in the towel and they're saying, I'm going to buy equities. So, when I heard Rick Reeder say that, Rick Reeder's, CIO of BlackRock Fixed Income, one of the smartest guys that know. And when you hold his feet to the fire and he asked him, what do we do in this market, Rick? He goes, buy equities. That tells you everything you need to know from the perspective of a bond investor. It's amazing. So
I had other questions, but I have to ask this one then. When we're looking at the S&P 500 dividend yield and the 10-year yield, how important is that? At what point do I say, you know what? It makes sense now to buy the 10-year because it's trading 20 basis points over the S&P 500 yield? Or does it have to be 50 basis points? At what point do you say, you know what, equities is a little risky here. The yield doesn't make sense. I'm going to go back into my tried and true 10 and 30 year.
Well, look, I hate to get technical, but what you're asking me is at what level? So that's a technical question, right? So the only thing we can do is look to the past for some sort of gauge. And so you have to look to the taper tantrum of 2013, and you have to look at, at what point did Bernanke step in and say, whoa, I didn't really mean what I said, right? Let's be clear. So, for me in a 2021 world, we haven't gotten there yet on 10 years. And quite frankly, it makes sense. We're not seeing financial conditions tighten. We're not seeing any sort of hiccup in secondary or even primary market activity in emerging markets, right? I'm talking dollar denominated now, by the way, which I can see. It's hard to see what's going on in local markets, to your point. But, what I see is, a relatively healthy market that's trading well. There's no fear there yet. The fear doesn't hit until we hit 2% in the 10-year. And my guess, and I think it's a lot of people's guess, is that we're going to get there a hell of a lot sooner than we otherwise thought. And my guess is, if the Fed doesn't say anything at 2, watch the market go to 2.25 just in the drop of a hat. I do believe the market has become really, really good, especially, with the Fed saying it's going to be outcome oriented, that it's basically going to sit on its hands and let the market dictate where it goes next. Quite frankly, I think the market's got no problem telling it where it wants it to go. So, right. I tend to think, from the perspective of, yes, U.S. Treasury yields are attractive relative to dividend yields in the U.S. Dividend yields right now, for sure. And I think they can get more attractive. And, I think, it's going to be, a little bit of, we're going to need to see the Fed sort of buckle a little bit before markets could come to the realization that, maybe now's the time that we want to really put some duration to work, some money to work in long duration assets.
Okay. Now, before we go, because the 9-year, 10-month tips just came out with a sexy bit to cover. So before we get into that, one of the things that I hadn't heard about in a long time after it was initially announced was the Hong Kong China two-way. So what does that mean? That means that they were initially supposed to use the bond market in going both directions to enable the movement of mainland China money into Hong Kong, foreign money in Hong Kong into mainland. And we started to hear that again in this recent congressional meeting. And it's something that they've wanted to accelerate the movements. Now, is this something where they're trying, when you're looking at this and trying to figure out, okay, well, what is their game here? Is it trying to get some of that mainland money offshore or trying to onshore foreign money through what might be a easier to swallow mantra because Hong Kong was the entry point? That's what made people comfortable, was coming into Hong Kong and trying to move that along. Or is it both sides? They're looking to play this on kind of an equal sharing platform.
I was going to say, I think it's a little bit of both. I don't think it's an explicit mandate in terms of where they, what role they envisage Hong Kong playing in the future of the Chinese economy. If anything, my guess is that Hong Kong's just going to be another big Chinese city, not dissimilar from others that we, Singapore, et cetera, in the future. Its importance as a global international financial hub has been diminished considerably in lieu of what we've seen in recent years. And so, I don't think that's changing. Whether or not it's time to call for a break of the Hong Kong peg, I think it might be a little bit premature to kind of go down that path. But certainly the HKMA has an awful lot of reserves. They've got a lot of cash, a lot of dollars at their disposal that they can use for Hong Kongers. Or, you can see Beijing kind of licking their chops, taking a look at all that cash and saying, well, how can we use that to help mainland Chinese? My guess is it's probably the latter. Now, does that mean, bringing all that onshore, repatriating Hong Kong, making it a part of the mainland? Or does it mean, kind of trying to show that Hong Kong is, independent, not so independent. It's more of a gateway. It's more of the bond connect, as it were. That CNH is still going to be, something that, you're going to want to need to use as kind of, speculating on the. I think for the time being, they're comfortable with the role Hong Kong has. But, it's moving very quickly in the other direction where, it's being, its importance, its significance is being diminished. And I don't think it's inconceivable to see in the next, call it 5 to 10 years, it's not going to really be a bridge to anywhere. It's just going to be another Chinese city.
Okay. So when we look at, over the last few, about month or so, we've actually seen China and Japan, but just for this conversation talking about China, they've actually started increasing their treasury purchases again. There was talk that they were going to sell some, now they're buying some back. Is this more along the lines of showing good faith where they still want to work and they're not going to try to aggressively get away from the US dollar as they've talked about in the past? Or do you think there is a certain amount of inflation concern and they're trying to get ahead of that, of bring in some T-bills, bring in some dollars, and kind of brunt what they see happening around the world of this inflation fear, of this inflation, talk, and having some of that dollars on your balance sheet, especially given the appreciation that we've seen off of the lows. I mean, or is it more of a political side? Because it's still small. It's still only 22 billion, and adding to the fact that they went from 1.07 trillion to 1.09 trillion or so, just in terms of maturities. When we look at that, where is this something symbolic, or do you think there's something meaningful, and we could see that accelerate as to kind of stave off some of the inflation fears?
Well, I think they just need a place to park their money. I mean, we're in a world here where there's a dearth of investable assets. And I think, especially for the Chinese, given, the receipts, it's probably come in, well ahead of the rest of the world in the past few months. They basically had no choice but to buy treasuries with that cash, right? I mean, and park it there. I know they've made both. I mean, they've been very upfront in saying that they want to diversify away from treasury holdings and diversify their balances away from the dollar. Easier said than done, right? I mean, just given, trade relations and the like. And I think this is more a function of that. China has been successful at reducing its treasury purchase, I think, across the board. Many countries, with the exception of a few like Taiwan and Singapore and some others, have really brought down their treasury purchases in the last year. A lot of it, quite frankly, I think was due to the pandemic, just the fact that, they needed to use those reserves and bring them, use them in other ways. But, I think invariably, it's not a fundamental, it's a structural issue. It's that there's just a dearth of investable assets out there. And at some point, you just see U.S. Treasury yields kind of getting to a point where they look attractive again relative to their EU and Japanese and developed market counterparts. And so, it becomes a buy for them. I mean, again, the SAFE and CIC, and I mean, they're managing risk just like the rest of us in this environment. Believe me, I mean, if they let politics get in the way of managing that money, things are going to be a lot worse. And the same could be said here again. If you're managing money here in the U.S., if you're going to let politics get in the way with you at least portioning a little bit of your portfolio to China yuan denominated assets, you're doing as a fiduciary, you're doing your investors, in my mind, a disjustice, because you're just constraining the investment opportunities available to you with which to diversify and build, and build a risk-adjusted return stream for your investors. And so I think that fundamentally is where I think most investors' heads are at in this environment.
Okay. So the last question on China, because it was something that struck me as odd, and we talk about it in the in segment 5 of our econ show, but the special purpose bonds and the bonds at the provincial level, there was a lot of talk going into the NPC that they were going to really cut back on this and try to take this down. But then when you look at the actual data, we're only seeing like a 50 basis point decline of what's available to issue. I mean, we're talking about a serious chunk of volume. And is this because they want to have that flexibility to push more infrastructure on a provincial side, or are they so concerned about rolling some of these assets that they're giving them a certain amount of leniency as a rolling capacity and not so much of a new investment capacity? I mean, how are you interpreting, or how do you think that could impact some of that investment on a provincial level?
It's a good question. I mean, I think China is trying to live up to its social contract of what is it, doubling GDP growth by 2030 or whatever it is, doubling GDP rather. And it knows full well that the only way it can engineer that is through infrastructure investment. I don't want to say bridges to nowhere, but Mark, maybe in another, we can talk about all the things we used to talk about in the past about what is the real return on an investment from some of the the things that China's done in the it's OBOR, One Belt, One Road, Africa, some of these investments, offshore. I mean, they're running way below what was initially kind of invested. And so, at what point does that catch up to China? So, for me, I just think this is more, China, knows that in order to get its GDP, growth moving in the right direction, it's infrastructure that's going to do it. And that means you're going to see a lot more special purpose bonds. You're going to see a lot more China loan. You see that loans have gone up. You've seen that it's aggregate total social financing. I mean, it's all right there for all the world to see. So, I do think that, there's going to be a concerted effort on China is using infrastructure as a way to kind of juice the economy, especially because I tend to agree with what you're saying. I don't see consumption coming online in a very effective way to kind of take the economy forward to where it needs to be. And, that means, quite frankly, it's more of the same. It's back to basics for China.
Now we're starting to run out of time, but I want to touch on one final point when we turn to the ASEAN 10 countries, and we've seen that mantra of trying to move supply chains, trying to diversify. We've seen Apple move out of some of their manufacturing, just trying to diversify, move away, try to look at this. And when we talk about the ASEAN, Vietnam keeps coming up as a spot of growth, as a spot of, then when you look at the import-export data, it's very supportive. So when we're thinking about, diversifying and looking at some of these emerging markets that could have some running room, even beyond a taper tantrum or some sort of outflows, I mean, where like you brought up Indonesia, when we look at Vietnam, Indonesia, some of these other ASEAN 10 countries, I mean, it seems like there's a decent amount of growth, and especially with the backing of India, the US, the UK now moving, pivoting further into Asia, they're looking to invest and they're looking to support some of these countries. I mean, where do you think is some of the better places or some of the ones that could attract the most capital, given some of this backdrop of the ASEAN 10 and their importance against both China and expanding the supply chain?
So if we're talking about attracting capital and return on capital, we're probably talking about two different things. So from the ability to attract capital.
Let's do both. Let's do attracting capital and then return on capital.
So all right. So the easy one is return on capital. So, which economies are most likely to perform in an environment where the switches are coming back on and cyclical bounce to the economy? Well, I mean, the one that stands out to me is Thailand, right? I mean, tourism flows are going to come back online and the like. But, that's not really what we're talking about. What we're talking about is what economies are a most likely destination if you're looking to move your supply chains from China to someplace else? Well, that's the Philippines. That's going to be like you pointed out, Vietnam. Although Vietnam is hard because they're not really a true investable economy yet. The Philippines, and Malaysia, for that example, they are. Thailand is. I think what's really kind of stands out to me is a place like South Korea, which, should probably do really well if we do see this rotation from growth into value, taking the other side of the Taiwan dollar, Korean won trade, right? Basically the fact that, if you do look at the value, it's amazing. If you look at the S&P U.S. equity value versus growth differential like that, like you index, and you compare that to Korean won, Taiwan dollar, it's like a beautiful, it's a very strong relationship, because that's the way you have to look at South Korea. It's a cyclical play. It's one of those economies that I think can do well here. At least in the near term from an investment standpoint. I mentioned Thailand. I also think Philippines as well. Less so in Indonesia, India, and probably, Malaysia's kind of is a little bit of a wild card for me because of its relationship to China, which could be both a blessing and it could be both good and bad. So it's difficult for me to get comfortable with Malaysia, but the others I feel relatively comfortable with. I mean, I think, it's not that long ago we were talking about Indonesia as one of the fragile five, and here we are today. And Perry Wajiru thinks that we can kind of buy our own bonds in the secondary market. No one's gonna penalize us for that. I just think that's kind of short-sighted. I do. I think as a investor, I get concerned investing into a local debt market in a place like Indonesia when I know the government is intervening and incredibly active there, because I just feel like there's going to be locals who know more than I do, and they're going to basically take advantage of the fact that they're local and I'm not, and they know more about which parts of the curve the central bank wants to support and which it doesn't, and so on and so forth. And it just most investors just throw up their hands and they say, well, why bother? It's a dead man. It's a dead man walking. So I think there's a real truth to that in the environment we're going into. But look, from a supply chain standpoint, which economies stand out? You're right, Vietnam. I think the Philippines as well. I think Duterte, early on was a scary individual to a lot of investors. But he hasn't been in the media. I mean, it's amazing, what a full 180-degree turn the investment world has taken with regard to Philippines as a viable investment destination and a viable partner. And I think much of that has to do with things that are going on in the South China Sea and the fact that the U.S. sees Philippines as a potential ally and its ability to kind of rein China in and what's kind of going on there. And I mean, look, I mean, there's a lot of, I mean, Mark, you know as well as I, there's a lot of concern going on regarding Taiwan. And, you know, Taiwan is kind of a very interesting animal altogether right now. In the, you know, just given Formosa buying and what it means for the swaption grid and what's going on in the world. I mean, it's really going to be interesting.
Yeah, there we cover a lot of that on our shows when we're looking at Taiwan, and especially given where we think, you know, Biden has essentially said, you know, Taiwan's off limits. I mean, we have Blinken who called it a country, which has been a no since the 70s. I mean, we're talking about some serious things that and when you look at the expansion or the U.S. looking to increase its military presence in the region, the Philippines is a huge part of that. So there's definitely a lot to talk about. And sorry, what were you going to say?
I was going to say, if you know, I did this analysis not that long ago. You know, if you look at, you know, gold or, you know, sort of a defensive risk-off hedge, you know, what's performed best, you know, during environments where U.S. yields have spiked, or just quite frankly, you know, in risk-off environments. You know, what's amazing to me is the best performing risk-off. Forget about Swiss franc, forget about Japanese yen, forget about gold. It's the Taiwan dollar. Why, you might ask? Because when those environments hit where we go risk off, everyone rolls out of the carry trade and everyone uses Taiwan dollar to fund their carry trades because yields are negative and low and, you know, basically stable, and the currency's stable. So it's a great funding currency. So when you have risk off environments, you know, look no further than the Taiwan dollar. It can be your best friend. And, you know, a lot of investors that I know in emerging markets have used that as sort of that, you know, that sort of ballast in their portfolios to basically kind of be that sort of tail risk hedge. And I think it still kind of holds up well, and I think it will continue to in the months to come.
Well, you know, I agree with you on that. So that's definitely a good position. And, you know, unfortunately, I want to ask you one more question before we go. Yeah. So when we look at short-term rates, we look at the overnight rates, we look at money market rates, and you see, you know, stimulus coming through, and you have this pressure now on the front end of the curve. When you look at a lot of this overnight going negative, you know, we have the SLR, we have, you know, the Fed trying to backstop, offering a certain amount of premium just to park your money somewhere. I mean, the last time I saw stuff like this was 2007, when we saw these restrictions on what companies could put into money markets because there just wasn't enough paper to go around. I mean, is this the market pushing that yield curve control, or is there something a bit more structural that we have to be concerned about? And is it similar to 2007 or something completely different?
You know, it's hard for me. You know, I am not nearly as close to the general account and to SOFR and to, you know, overnight reverse repos going negative as I'd like to be, just because I'm responsible for covering 150 other countries throughout the globe. But no, I do. Look, I can't do my job well without having at least an opinion on where we're going in the front end of the curve. And I'm going to lean on my colleague, Ira Jersey here. And, you know, he doesn't think that that these are issues, you know, that the Fed has firmly got, you know, their finger on this one. They know that, you know, with what's going on here, you know, what is it, what's the SLR cap or whatever that, you know, they have till the end of the month to remove. And, you know, what does that mean? And does that mean that, you know, banks are not going to be able to, you know, lend as much because they're holding too much treasuries on their books? Yeah, I mean, those are all viable risks, and they may very well be true, but it seems to me that the markets aren't really overly concerned about that right now, that the credit impulse is strong and it's not going away. And certainly the Fed had mentioned yesterday that we are going to hear some news on that imminently, whatever that means. And so I'd like to see a little bit more color before opining. I think it's very different today than it was last year, when we basically saw capital flows moving in reverse due to the pandemic, you know, which, you know, which happened with a lag. You know, people didn't realize, you know, during the year-end turn last year, just what was going on in the world and how dire the situation was. And nobody really realized, you know, until it was March, April, and oil prices were negative. You know, I mean, people just didn't understand the payment process moving in reverse and what that means. And by that, it's a very simple thing. You know, I mean, China doesn't really manufacture anything. What they're doing is they're an assembler. They're putting things together. So, you know, if China doesn't have the cash to pay Taiwan and South Korea and Japan for the components it needs to put stuff together because there's no demand for it, it takes time for that trickle effect to kind of work its way through the market. We've gotten past all that. We've gotten through it. I think, you know, it's safe to say we're not in a, we're in a very different situation today, and one that I think the Fed is kind of very capable of handling. And I don't see any real hiccups in the Fed plumbing right now. But again, I'm not as close to it as I'd like to be.
All right. Well, Damian, thank you. So it's always a pleasure talking and going through all this. You can find him.
I have questions
on
for you,
LinkedIn.
Mark. I have a lot of questions for you on oil, on copper, on grains, but we'll get there later.
We'll definitely have you back where we could go through even more of this. But you can find him on LinkedIn. He's always posting some great charts. The stuff that he also has on Bloomberg, and you can always find him on Bloomberg and his spots on television. So Damian, again, thanks for joining us.
Thanks for having me, Mark. Cheers.
Anytime. Well, again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.